Welcome back to Data and Context. I'm Allie Barefoot with Cotality. This episode is a part of a mini-series where we break down Cotality's monthly home price index report. The US housing market is officially building momentum, but it's doing so in a way that's completely splitting the landscape of buyers into two distinct camps. According to Cotality's newly released July 2026 home price index report featuring May data, shows year-over-year national price appreciation accelerated slightly to 0.8%, which is up from April's 0.6%. But on paper, it looks like a slow, synchronized grind. When you look past the national numbers, you find a clash between an affordability gap and a wealth gap. Budget-minded buyers are driving massive surges in the Midwest, while AI-backed tech wealth is supercharging select coastal metros. To help us break down this data, I'm joined today by Cotality's chief economist, Dr. Selma Hepp. Let's put the data into context. Welcome back to Data and Context, Selma. Always a pleasure to have you on the show.
Thank you so much for having me back, Allie.
Yeah, we're talking about the July 2026 Home Price Index report featuring May data, and I want to look at the baseline acceleration first. In your opinion, what is happening under the surface that's caused annual price growth to firm up this spring compared to last year when we saw price drops?
Yeah, what we are seeing this spring is not necessarily a broad-based boom. It is acceleration in home price appreciation, but it's really about a market that has found a firmer footing after last year's softness. What's important to note is that last year's April surge in mortgage rates, coupled with macroeconomic uncertainty, think tariffs and such, led to weakening in home price growth. We didn't see the same this year. So part of that acceleration this year also reflects weaker base effect. But generally speaking, annual appreciation at this point illustrates a market in which inventories are still tight, but also where sellers are becoming more realistic on price. Importantly, this summer is been underscored by a market that in which demand has not disappeared. It's selective, but it has not disappeared. And households that can buy are concentrating in markets where affordability still works. So a lot of Midwest, partially Northeast markets continue to see strong demand. And then also higher income and equity-rich buyers are supporting demand in higher cost markets. So, the national number looks modest, but underneath there's a lot of movement and continued divergence.
Yeah, and you mentioned there a little bit more about the affordable Midwest, and I want to focus a little bit more on that region because the state numbers, they're pretty remarkable right now. Illinois led nation year over year growth at nearly 6%, followed closely by Maine and Indiana. So, why are these budget friendly pricing tiers proving to be the primary economic engine right now?
Yeah, these markets are benefiting from the simple fact that affordability still matters most than anything else in this market. Buyers are very payment sensitive, and in places like Illinois or Indiana, the combination of lower price points, at relatively stable job markets, and just better value is drawing that demand that has been potentially priced out elsewhere. The other thing to think about is that these markets did not experience the same pandemic era price run-ups as we saw in some of the other markets, particularly in the Sun Belt and coastal markets. So they have less froth in a way to unwind from. Put it differently, Midwest is not necessarily overheating at the moment. It's just benefiting from being one of a few places where the math still works for most buyers.
And we know in economics and really in life, there's always two sides of the coin. So the Midwest being one side, let's look at the other side of that, where we're seeing the absolute other end of the spectrum, which is on the West Coast. On paper, high value regions look like they were struggling a little bit, but Cotality highlights San Francisco. It's showing incredible 8.9% growth rebound. And the velocity of that rebound is wild. Can you talk to me a little bit more about that region?
Yeah, so most of this increase, 8.9 increase, actually we've seen over the course of last few months. And San Francisco is a really interesting example of how different cycle can be from traditional affordability driven recovery. This is not a market where a typical first-time home buyer suddenly has a lot more purchasing power. It's nothing like that at all. We've actually seen not a lot of resetting in terms of home prices. We have seen relatively slower rate of home price appreciation throughout the pandemic in San Francisco, but now that has turned into a wild roller coaster ride again. But this rebound is being driven by wealth. It's being driven by stock market gains. AI confidence, and it's all again still built on very limited supply of desirable homes. AI has added a really interesting layer to this story because it's supporting incomes, equity compensation, and expectation of future wealth in parts of the Bay Area, which has helped boost this rate of home price appreciation. So even though mortgage rates have not been lower and they continue to be a headwind, they're less binding for buyers who have substantial equity, have high incomes, and ability to make larger down payments, as is the case in San Francisco.
Right, that makes sense. And when we look at the West Coast, we've looked at the Midwest as well. I kind of want to focus more so on the markets that seem to have run out of gas a little bit, per se. Cotality's report identifies a few notable cool down metros where the short term trend is completely rolled over. For example, Rochester, New York was a long-term appreciation darling, but just printed a 3-month decline of negative 1.8%. What is the data kind of signaling there?
Yeah, markets like Rochester show us that even some of the pandemic era and affordability winners are not immune to buyer fatigue in essence. Home prices in Rochester over the course of the last years have seen one of the strongest appreciation in country. So cumulatively since the beginning of the pandemic, home prices in Rochester are up 77%.
Mm.
Now, this 3-month decline does not necessarily mean the long-term story has reversed, but it does tell us that buyers are pushing back in some way. When prices rise quickly in markets that were generally attractive because they were more affordable, they can, eventually lose some of that advantage. And that's what is happening in Rochester, in New York. We are also seeing more sensitivity to inventory changes. So even a modest increase in listing can cool price momentums when buyers are already stretched by mortgage rates, insurance costs, property taxes, in broader household budget pressures.
Yeah, that's definitely an area I'm going to keep my eye on as we continue month to month with our home price index reports. And looking ahead, Selma, until we see that sustained relief in mortgage financing costs, like we previously mentioned, do you expect this deep wedge between equity rich buyers and first time homeowners to widen even further, or will regional inventory shifts finally force a leveling of the playing field a little bit?
Yeah, unfortunately, I do think the wedge is likely to persist. It's the reality is wealth accumulation accumulates more. So
Right.
equity-rich buyers are simply operating with more flexibility. They can trade down, they can make larger down payments, they can buy with less exposure to cost of financing. When, on the other hand, first-time buyers are living and dying by monthly payment. So with that in mind, regional shifts do matter in markets where supply is rising and sellers are adjusting expectations. Buyers may regain some negotiating power, but the playing field in some way will still never truly even out until we see affordability improve significantly through some combination of lower rates, slower home price growth, stronger income growth, and just generally more a supply of homes available for sale.
Well, we'll have to definitely keep our eye on those lowering interest rates and hopeful that affordability will come back into play for not just one section, but all section of home buyers. But Selma, thank you again for breaking down this data. It's always super insightful.
Thank you. Thank you so much for having me again, Allie.
Thank you again to Dr. Selma Hepp for joining us here on Data and Context, and thank you so much for listening. If you haven't already, subscribe to Cotality's YouTube channel, and as always, if you want to find out more information, head on over to cotality.com.